Hello, hi guys, Nick here. So today we have my second stream, actually trying to be consistent and do regular streams. So we're going to go through frequently asked questions. So I've just got my screen up and scribbled down some notes to give us a bit of structure so we can run through that and yeah, give you guys an understanding of what typically investors ask. So yeah, I think we're good to go. As a recap, I am the MD or founder and MD of a co-founder of this company of a property investment agency in the UK. So we help investors from all around the world purchase property in the UK market 100% remotely in a fully managed hands-off structure. So when I say around the world, I mean mentioned this before, but multiple countries, Singapore, Hong Kong, Malaysia, UAE, Saudi, Nigeria, Turkey, etc., as well as UK investors. Now, a lot of the properties that we work on and developments that we bring to market, they're going to be in places which are high performing in terms of capital appreciation and rental yields, or there's something unique about them that which is really going to get our investors ahead of the crowd and get them interested in the product. So that's not always obviously going to be where the investors are based. So even 9 times out, I would say 99% of our investors, even our UK ones, they're never going to visit the property or view the property or certainly not manage the property. So that's really important to take into account. As a result of that, they do ask a lot of questions. And over the years, I've had many questions. So today, I want to run through the top 5 and just give you a bit of insight and knowledge into the key kind of things that may be on your mind if you're considering investing and you're new to intermediate. And hopefully, that will give you a good starting point, a foundation to assess your own options and your own investments. Okay, so the first one is location broadly. So how do I know if it's a good location to invest in? Now, I've got a couple of notes written down here, as I say. So a couple of things to think about here. And again, remember these lives, guys, they're off the cuff and they're just like I'd be speaking to someone on the phone, although I do have my notes here for a bit of structure. So firstly, you want to think about your strategy. So are you more focused on rental yield or are you more focused on capital appreciation? So if you're saying, look, I want to get the most capital value rises as possible. In other words, I want to see the property increase as much as possible over the coming years. Then you're going to be looking at places, typically the northwest or somewhat the northeast as well of the country. Whereas if you're focused on cash flow and getting the most out of the property, you might find that secondary cities, which has a slightly lower ticket price, will have a higher rental yield. So your cash flow on a monthly basis might be typically higher. Or if you're like super risk averse and you just want the most possible stable income, then you can look at places like London or especially commute about locations in and around London where we know the tenant demand is so high. So it really depends on your strategy in terms of how capital appreciation and rental yield affect your decision. Regeneration and infrastructure, universities, hospitals, employers, these are all things that you want to think about as well, particularly in terms of how your property is positioned in relation to them. So if you've got a property which is near a hospital, that's kind of a big selling point because you know you're going to have staff there that need property, etc. But that works the same with obviously transport links. If you're near an airport, train station, all the fundamentals of investment, which probably most people know to check for, still does make a difference in 2026. City centre versus commuter belt and secondary towns. So as I mentioned, we very rarely take developments to market in central London, zone 1 and 2. It will, although we have just taken one on in Battersea, which is zone 2, but it's very close to Clapham Junction. So it's kind of got zone 1 connectivity, but it's very rare we do that. We only took that on because it's a flashy new build, it's waterfront, it will have a lot of demand and it's in a phenomenal location. And normally we're looking at stuff which is, 30 minutes to 60 minutes from central London, because that's going to allow us to get that rental yield. Okay. So in other words, we might get a 5% yield rather than a 3% yield after costs. So that gives us a bit more cash flow on a monthly basis. Secondaries, towns and cities. So we see a lot of demand for places like Huddersfield, Preston, even Bradford sometimes, believe it or not. No offense to Bradford. In and around Newcastle, Sunderland, So yeah, places like that we do see a lot of demand for, whereas then we also have our key city centre locations where it's really our bread and butter, where we mostly focus: Manchester, Liverpool, Leeds, Sheffield, Birmingham, etc., etc. So they're kind of the core ones that we look at, but it's all catered to your strategy, right? So do you want a balance of yield and growth? Do you want just growth? What's your risk appetite like? Do you want to be definitely near transport links, or do you want to rely on, tenants having cars, etc.? So there are kind of things to think about. And just lastly, in terms of the actual recommendation, where to look at, for me, it's the Northwest region. So places like your Manchester to Liverpool's, it's our bread and butter. There's a reasons why that is because of the ticket price is lower than like the Midlands and the southeast of the UK. As a result of that, the rental yield is higher. The price per square foot is better, not just the ticket price in general. And the cash flow, especially if you're doing things like short-term lets, you can get 8, 9, 10% net if you're looking at the Northwest region. Now, that's not just based on my opinion alone. If you look at data from companies like HomeTrack, Office for National Statistics, the current performance of these cities and regions are much, much better than other locations. And if you look at Savills residential market forecast over the next 4 or 5 years, it's showing the Northeast, the North West to do exceptionally well in terms of capital appreciation, up to about 28.8% is forecast over the next 4 or 5 years for these regions. So they're doing very well now, and they're expected to continue in that light. So they're the kind of things you want to think about with regards to location. Now, moving on to point 2, mortgages. Can I use a mortgage for my purchase? How do I go about that? What's the deposit that I need? So with buy-to-let mortgages in the UK, typically require a 25% deposit. The loan-to-value rates typically sit around 75% for most investors. In other words, that means the lender is going to give you 75% towards the property value, and you need 25% plus costs yourself in cash for the purchase. Now, you've got to be careful not to mix that up with what the developers are asking for during the construction period of off-plan purchases. So, for example, we might market a project which is going to finish in 18 months. Developer is only asking for 20% of the value now, but that doesn't mean that you can just put in 20% and the rest on mortgage. It means that you've got to put in 20% on construction. When you get to completion, you'll probably need to put in another 5% cash, because the lender is going to give you 75%. So yeah, typically you're working with a 75% LTV rate, which means you need a 25% deposit, but be careful not to mix that up with what the developer is requesting during off-plan projects, which can be 10, 20, 25%, etc., which is required during the build timeframe. So keep that in mind as well. The next point I've mentioned on that obviously interest rates and deposit levels, they can vary depending on a number of factors. Obviously, the resident status of the investor is quite a big one. So if you're overseas investor, then you might have to pay higher interest rates, or you might have to pay a larger deposit. Some countries you won't even get lending, especially at the moment because of the war. A lot of mortgage products have been affected. Some have been pulled from the market. High risk countries just have no chance now. So you do have to assess your options of mortgage lending prior to committing to an investment. You don't have to, but we recommend you do. We've got mortgage brokers that you can work with for that, but you can just speak to any mortgage broker that you can find online on Google, and they'll give you the relevant advice. And the only other thing I'll mention are mortgages as well, is that deposit levels for residential purchases. If you plan to use the property yourself, then you can get that as low as 10% deposit level, so 90% LTV. And the other factor that might affect things would be if you're buying in a company name or an individual name. Buying in a company name, it can slightly increase the interest rates. If you're buying in a personal name, it can be more favorable terms sometimes, especially if you've got a good profile and the property is set to generate a good income. But often the tax benefits may outweigh the benefits from the interest. So keep that in mind and get the relevant advice there. So that's mortgages. Yes, you can use them for off-plan. You wouldn't be formalizing the mortgage during the construction period. You would only be doing that when you get 3 months out or so from completion. But yes, you can use them. Rule of thumb, just keep in mind you probably need 25% cash. So that's mortgages. Property management. Who will manage the property for me? I'm not based in the UK. I can't visit there. Do I do short let? Do I do long let? Etc. etc. So questions around management are very, very common. So firstly, most agencies similar to ours, our competition, etc., will offer you a recommended management partner where they've looked at the project. They've said, yeah, we'll probably get this on the rental income. We can look after this. We'll charge you this much per month to do it for you. Now, that can be fully managed. The benefit of that is, one, you're not going to get people calling you in the middle of the night. Two, they're going to be able to fetch generally the best market rate. They'll probably be a bit more switched on. They've probably got a tenant base in the local area where they can get in and view the properties. So generally, it's more beneficial. But obviously, there's a lot of regulation changes coming in April 2026. So having a management company normally means that you'll stay compliant and you'll keep on the right side of the law, which is a big one as well. Costs for that are typically 10% plus VAT of the monthly income is about the market rate. You can get deals from companies like ours with our in-house management where you can get that lower. And sometimes it'd be higher for premium service in and around London, for example. But normally you're looking at around 10% plus VAT of the monthly income for a fully managed property investment where you never have to handle any stress or deal with any tenants or things like that. So yeah, that's one good thing to keep in mind. And obviously for that, they'll do rent collection, register deposits, deal with the turnaround, which is when people leave the property eventually, check in, check out, cleaning, all those bits and bobs, manage maintenance on your behalf, et cetera, et cetera. So that's the long-term let and the traditional model, what most people think of. But you may have seen short-term let management advertised, where what they'll do in that case, if your development is legally approved for it, is written in the lease and you've got authority, then you can rent it on the short-term let market, which means you appoint a management company, they'll rent it on Airbnb or Booking.com, advertise it to people that want to come and stay in the short term. You know, they're visiting a city, they're visiting people or friends or family at university, they're going for business, they're going for leisure, et cetera, et cetera. Huge demand for it across major cities in the UK. Again, we've got companies that we work with, but you can easily find them by Googling short-term let management company. And by doing that, you have to pay more. So typically you're looking at about 15% plus VAT of the monthly rental income, but you can generate more, sometimes 20, 30% extra by doing that model in comparison to doing a long-term let model. So keep that in mind as well. So that's management. Basically, management is very simple. You can go online and always find a management company. Don't worry too much about that. Just make sure they're reputable and you trust them. Cool. Tax. Should I buy in my personal name or should I buy in a company name? That's another big one we get. Now, I can't give direct tax advice, but I kind of give it at surface level. So in most cases, investors are buying in company names these days for tax efficiency, well, for a number of reasons. So keep that in mind. If it's your first buy to let or your first property, sometimes it's a bit easier just to buy in your personal name and not have to worry about doing accounts or self-assessments, etc. if you're a director of a company. But get the relevant tax advice. In most cases now, it is beneficial to buy in a company name. So if you're getting someone that can give you specifics around that and let you know the pros, the cons, the potential difference, give you an illustration. One thing that a lot of people forget is the exit strategy. So, if you're selling via a limited company to your next investor or next buyer, it may be more beneficial than just selling the direct asset. You've got to think about inheritance tax effects as well. Again, this regulation is changing constantly. So having a good qualified accountant on hand to assist you is really beneficial. And again, we can help with that and we can set up a company for free for our investors. We'll do that even if you're not doing business with us. So let me know if you need a hand with that. But ultimately, the long story short is you will have to pay some form of tax in the UK. That's the cost you pay to invest in a tier 1 country. Although it doesn't feel like a tier 1 country all the time, it is incredibly safe, secure, robust legal system, a demonstrable track record of appreciation, huge tenant demand because there's an undersupply of housing, big major universities, employers, etc., could go on forever, but you're going to have to pay tax. That is a cost you have to pay, but we can optimize it. We can be efficient. We can do the relevant tax planning, especially in the medium to long term. If you're building a portfolio of multiple properties, you've got to think about things about, dividend or director's loan repayments, how to extract capital, how to form trusts, group structures, how to exit, putting certain amount out per tax year. All this stuff you have to think about and get right if you are really serious about investing. Cool. So that's tax. And then the last one, just to wrap things up, how safe are guaranteed returns? How do they work? Are they worth looking at, etc., etc.? So there's a number of guaranteed returns that you can get in the marketplace. Sometimes if we're selling a block for a developer, we'll say to them, look, can you give us a guaranteed return to our investors to make it more enticing for them to purchase during the construction period? Sometimes we'll partner with management companies and they'll do a deal on their management fee and we'll contribute a bit so we can get a fixed rent for the investor. Again, this should all be contracted and formalized in an official agreement. And then lastly, what you see now a huge amount of in the UK market is agreements with local authorities, where it's actually the local council, a charity, a housing provider who are registered, effectively government-backed income, who are providing these agreements across the UK. So they can be phenomenal. Sometimes it does restrict. Well, I'll give you a couple of warnings to be aware of, because you understand the benefits of a fixed return or a guaranteed return. You don't have to worry about void periods. There's less risk. You know what you're going to get month in, month out, and you typically got that for a certain period of time. So we all understand the benefits, but the risk factors you need to be aware of. Number one, lenders do not like them at all. Okay, be very, very careful. If you've dealt with the same mortgage broker for 10 years and you want to use them, and you're not going to invest unless you can use them, and you go and secure a property with a fixed return, and that broker can't access the right mortgage product for your fixed return property investment, then you're going to be in trouble there. So you do have to make sure that you're dealing with the right lender against that property. And not only you're dealing with the right lender, but they're sending the right valuer to the site. They're sending them at the right time. It can be relatively complex. So don't just buy a fixed return investment and think it's a straightforward mortgage process. You have to be shrewd about it, and you have to manage it appropriately, because most lenders, they want normal tenancy agreements in place direct from a tenant. They don't want a corporate tenant, which is what it might be. So keep that in mind. So lenders don't like them. Number two, you've got to make sure the values stack up, right? So a lot of developers, believe it or not, well, it's very easy to believe. They might hike up the price slightly to allow a margin for them to pay a guaranteed return. So sometimes referred to as price loading. So you've got to make sure, yes, look, you've got to be realistic. Sometimes you might pay a slight premium if you've got a property there with a guaranteed return for 10 years. Okay. So just make sure it's viable. Make sure there's still a bit of growth into it, or equity to be made in the deal, should I say, in relation to other investments on the market. So just keep that in mind as well. Sometimes the prices can be affected slightly. You've just got to make sure it's not an absolute joke and they haven't taken the mickey, so to speak. So keep that in mind as well. Lenders don't like them. The values are sometimes edited. And lastly, you've got to make sure that the resale ability is attractive as well. So you don't want to get a fixed return for 5 years. You keep the asset for 5 years and say, right, I want to sell now. And now all of a sudden the asset generates a 3% return in Manchester. Then you're not going to be in the marketplace. It's not going to be attractive enough for the next investor. So the advice I give people is make sure the underlying performance of the asset is strong without the guarantee. Okay. So imagine there's no guarantee. What will this property generate for me? And it's not going to be as much as the guarantee in most cases. But if it's on or near the market rate, then that's great, because it will increase over time as rents rise. And if you can shave a bit off the asking price as well, that tends to make it more attractive. But that's what you want to do. The key phrase or the key term to consider is make sure the underlying asset performs well without the rental guarantee. But don't just rule out guarantees. They are very attractive if they're used correctly, if they're done with integrity, if you're using the right reliable partners. They can be a really phenomenal source of security and an ability to achieve above market rates and rents for property investors. So that's it, guys. Hopefully I'll read through that relatively quickly. So we covered location, things to consider there, mortgages, property management, tax and guaranteed returns. Any questions on this, drop me an email, nick.highland@vertapropertygroup.co.uk. Information will be in the description below, or have a look at our website, vertapropertygroup.co.uk, and we can give you the relevant advice. But yeah, thanks for listening, guys. We'll see you on the next one.